Okay, in my sadness about finance.yahoo.com, I discussed a few issues. One of the issues was the difficulty in downloading data uh, from Google Finance. Another issue was not getting enough history. A third issue was not recording the stock prices that includes an adjustment for the reinvestment of dividends. Now, those last two, going backwards further than the year 2000, is a problem, although now I think we have about 17 years or 16 years, so it's not perhaps so bad. And I demonstrated some issues with getting good kind of statistical analysis on this data. Now, right here I have an index of the U.S. stock market, and that's the final issue. The issue is that downloading indices from Google is either I don't know whether to call it impossible or extremely difficult. And that causes a mess, because with this index, if I want to, here, there's a beta apparently here. It doesn't look like it follows the index that much, but we have a beta of 1.5, which is our kind of measure of risk. I'm going to talk much more about statistical analysis in the next video. But, what we kind of want to do, I believe, is if I look at Shell Oil here, they have a beta of just about 1, and then we can put the beta in terms computed on the basis of a daily stock prices versus monthly stock prices, and we can get the beta of Exxon, which is just about 1 as well, or we can get some of these smaller companies. Well, this one didn't have a stock price until a couple of years later, so we have to do that. Now, of course, the beta perhaps should be computed over 60 months, and we can get kind of all intricate with it and all this. So this beta was really low, but let's get a couple of other beta. So this video is going to be about how to get data on the stock price index, and just look a little bit on where you get these indices. Now, the same issue, by the way, is for oil. I want to get the in this case, we kind of can do a beta of the oil price, just like we do a beta of the stock price. Now, here's something that it's a little bit tricky. If you look at Chesapeake, let's go to the first one. For me, it looks like, well, maybe it's hard to tell, but perhaps if we go down here a little bit further, the stock price here's the oil price. The stock price seems to move more than the oil price, and we get a beta against the stock price of 0.69. We get something else. We get volatility of oil of 32%, volatility of this stock of 67%, suggesting there's more risk. It's more volatile than the price of oil. And after we hedge out, after we take out the price of oil, we're left with a pretty small volatility, and maybe that's the volatility, and that's the series that should be judged against the stock price. That gets into this whole arbitrage pricing model and what it really means, rather than just some vague kind of statistical analysis. So that's a long introduction, and the reason for this introduction is really, or the reason for this demonstration is to show you that how to get this data from this Fred database, see how to kind of document the data, and then finally show you which data is really the most useful data in representing an overall stock price index. And then I suppose we can just compute the beta, which in the simplest way is just using the slope function. You just simply take the percent change in the stock divided by the percent change in the index. All right, now to kind of go through this, I'm going to try to explain what's on this Fred database. By the way, I just opened this file called Country Economic Database, and I hope you're anxiously awaiting the discussion of that. But this gets data from the Fred database as well. This Fred is this, I don't know what Fred stands for, some St. Louis Fed, so how they get it, I should know. Now, in this database, I downloaded 2,400, or a little bit less, because you have to have this different series. And then that's how, with this 2,400 different series, plus the indirect function, that's how we can take, just a minute, this gives us a database. In this case, this has the population of different countries. Okay, and I showed a little bit of this in the last thing, but if we want to, we could go all the way back to, I think, 1960 or something, and we can just select different countries. In this case, Ghana is kind of way off the chart. This is an index, so we're not comparing absolutes. And then we can see that Jamaica had a higher level of population. I think, I'm kind of embarrassed, but Barbados didn't really have one. If I put Bangladesh here, and let's put the DRC, you can kind of see the different population trends. And that population trends, now the fact that Barbados didn't have data is not that big a deal to me. You can see also that this is a very large database and perhaps a little slow, but then we can also look at things like the population above 65, the life expectancy, you know, all of these kind of data, and there's enough kind of data that you could do perhaps some real statistical analysis, although I'd be really careful about that. So that is all working with the Fred database. Now let me explain how mechanically this works. Now this database, they're all on, as just a minute before I'm explaining this, look at this, I'm kind of just modifying this page, but this page is on the website. It's called Databases, and it's got all the databases and a little video associated with kind of them all. Here we go. Okay, this is download web pages. It's got some of the links, how to get the currencies, cost of capital database, commodity database, and this is where we read this is this economic database I'm talking about. I'm going to talk about reading indices, and mostly this is the stock price stuff we are talking about. Now, to get the Fred database, I have a file, and it's not maybe really quite as elaborate as some of the others. Okay, just 1 minute. So, I suppose I'm a little embarrassed. This stands for Federal Reserve Economic Data. Duh. Okay, now if you go categories, let's say. And we go to money and banking, and how about some financial indicators? There are 190 of these. There are 82 different stock market indices. Here's one for the S&P 500. S&P 500 is updated daily, and it gives you this. Now, if you want to download this, here's what you have to do. This is almost too easy. Do you see this little thing in the brackets? You have to know that, and you can download this into a text file. They used to allow you to get the text file, and now they just allow you to download into CSV or PDF graph, and if you download it into Excel, great. You can download one by one into Excel. They even have, I know, they have some kind of tool or app or something that I haven't tried really that allows you to kind of get the data, but we want a way to update it automatically. Now, the problem with the S&P 500 is that it only starts in 2007. But then we have this thing called Wilshire, I suppose you pronounce it like that. And here's the little code number. And this one goes all the way back. I think it went back to, when did it go back to? It went back to 1970. And the NASDAQ composite goes back to 71. So you got all these different indices. Now, I did something that I hope you'll find a little bit useful. Now, I just finished this on the plane, and I've got to make it a little prettier and everything else, but I'm trying to kind of make this series of databases for you. What we really want is daily data. Now, there's one other thing they have. They also have, if we go to the, suppose here, I want the categories, and in the categories they also have some prices, and they have 390 different commodity prices. Commodity. I didn't think they had so many, and on this commodity prices, some of them, like the oil prices, are daily. So here's it says D for daily. You can start looking at these kind of codes and trying to get some of them. So that's how I think it's so important to get that we can get daily prices. And if we get daily prices, we can always just use the match and the index function to only get the monthly prices, or we can use the average if or sum if, but getting the finer prices is the really important thing. Now, once you have that, okay, here's what I did. Oh, they also have indices for all these different countries. Stock price indices for all these different countries. I'm in the process of trying to understand whether those are like the French is the CAC 40, or if it's adjusted for in euros or in US or some other currency. I'm struggling with that a little. They have all of these countries and probably more have and these are what's in those little brackets. This is the stock market as a percentage of the GDP for the countries, and here are all of the indices we just looked at. So I did the painful part, which is putting these together. And then I said, well, let's just make a range name. Let's make a range name, and this will be the sheet name. Let's put and this is the key. I should have probably started with this. Here's how you get the data down. This little thing here, this is what's in those brackets. It used to be clear, and now they changed it, but now you can still get that. So all you do is take up to the data, up to the slash, just before the little code that goes into brackets. Then you can make an index function, and in this index function, let's put number 1. This is the total number of series. It's just got to count. Okay, so we count this one, and the first one is the Dow Jones Industrial Average, and the second one, the second one is the Wilshire. I had to do a little bit of work to use the substitute function to remove the parentheses. That's kind of a minor thing. You can look at this after I post this video. Okay, so this is the sheet name. Now I made a mistake because some of these sheet names are too long. Okay, now when you read the index, let's just look at the macro. There are a few things to look at in the macro. When you go to assign macro and edit, the first thing is you want to read the URL. Now, I defined the name here. This is called the Fred URL. This is just, I use Shift Control F3, and I defined the name. Okay, and then I need a error checking function because sometimes the name of the sheet is duplicative or there's a problem with the name. But we just use the classic Workbooks.open. Okay, and then once it opens, we put it in something called temp book, and there's a sheet in temp book and temp whatever. And then we go back to our base book. Now, up at the very top of the whole thing, I put the base sheet and the base book in as a public variable, and then we define that before we read the individual series. Now, the only problem here is once you read it in, when you look at the text file, the dates and the values, the dates are always in column A and the values are always column B. So you have to use the text file and use a delimiter that's a space. Somewhere in here it must say that there's a space is the delimiter. Here we go. Okay. All right. That's just, you just record a macro and made it. Okay. And then here is the problem. When you read in, let's do this with one of the, okay, this is how the text file looks. Okay, after this is before you've read it in. Now, if we would go to here and go to data and then text to columns and then delimit this with a space, okay, and data's already there, but it puts it into some thing like this. It puts all the data and everything else, so I'm undoing that. But what you have to do is, after you've delimited it, you want to just go only down to where the date is. So you find the minimum date, and then you want to re-put together this back together, because these descriptions are really pretty good. And then once you have this, in column A, you're just going to be able to use a match index. You don't care what column, what row number it is, because we'll just use the lookup. Well, I said match index. We'll use the lookup. We'll just have a common date. The whole key thing is to have a common date. And I did this over here. Okay, we put a common date here, I hope. And this date I actually took from the trading days for the S&P 500. And once we have the date, just like all the rest of this, here is our, I'm going to get some other index. Let's go to the Dow Jones Composite, okay? And then we just use the lookup on this date, and it might give us an NA. If it doesn't have it, that's fine. And we go to that sheet name, and we get it, and we put it all together. Now, let's keep going through the macro. Okay, and then so what you do is, once you find the minimum, this section where you start with the column and you go row by row, and you just say, well, let's just keep appending row, the last thing we had in the column, and then we put a little space in between it. So we just put it back together, and then we take what was in the column and then just blank it out, so that we put everything back into column 1 and just reconstitute all of that. Okay, and then I also made, if you look at this, I also made a little, because we have so many sheets, you know, you might always want to go back to the menu sheet. Sorry about that, I actually didn't do that right, but we can just make a little table of contents that gets all the sheets, and then we can go back and forth. I named the thing wrong in macro. Okay, I told you I didn't do this really carefully. So this, where it says base sheet, this should say the base sheet should be the content sheet. That's we'll leave that. Okay. Once you've done the hyperlinks, then you close the temporary sheet. You go back to the base sheet, and if there's an error, you can list out the error. Okay. Enough of that. I'll be talking about the errors a little more. Now, once you've done that, okay, I put all the indices together, and in the indices, so just think about what's going to happen. We're going to read the Google thing in, and we can read however many indices or gas prices or oil prices or coal prices or anything else. Okay, now, if I also change the index so we can read it at different times. Let's just look for first. They have something called the United States Index. Now this blue line is the S&P 500 from finance.yahoo.com, and it doesn't follow things exactly. It does it. Okay, and what I did is I said, okay, let's start the index at different periods. And kind of what worried me a little bit about this U.S. index, it looked like it was all reasonably similar, especially if we start here in 2005, I guess. But then it kind of went too low recently, and so I'm going to investigate that one a little more. Then you get down, if you want to compare the U.S. to China, or the S&P to China, I guess, and you can start the index at different dates and see how the kind of indices compare. And I kind of like doing this. When you do this, clearly, you better be absolutely sure you're measuring it in a common currency. That's pretty obvious, I think, but it's an easy way to kind of get distorted, so we can kind of look at the performance of different countries over different periods. India, I think, had a really high stock price, and then poor old France doesn't look so good recently. Okay, and let's look at Switzerland. I don't know what happened there, and okay, Greece. All right, so that's good news, and then we can go down to the. Let's look at UK. Not so good recently. Okay, and then we go to the Dow Jones Industrial, but we only had recent data, so I have to push this up to get, and this is just a drop-down box, and I just put it in every 5 years, because I thought that was, and I think that technique of using every 5 years or something on these kind of things. So you can, just shows the S&P 500. And notice that this stopped in January, because that's the last time I downloaded this from the S&P. Now this Wilshire 500 seems to be getting a little close, and then we put Wilshire 500 large cap, and we go backwards, and it starts to look pretty good compared. So I'd say so far, if we want something, and here's the thing, I have the NASDAQ going way back. Okay, this is the NASDAQ. This is the famous bubble in the NASDAQ compared to the S&P 500. But when we look at the S&P 500 itself, this is the sad part. And remember, we couldn't get it from Google, so here's the sad part, and I'm finally getting to the answer. Okay, I'm trying to show you too this whole business of making flexible indices. Isn't this pretty good? Okay, so here it matches. I guess the dates were a tiny bit off, but it's the same series, and then we don't have anything over here. Okay, but here's the problem. It just started in 2010. Now, if I go back to this thing called Wilshire large cap, and I had a problem with the range, it gives you almost the same kind of thing. And then you go back, and it's whoops, I couldn't go back. It seems to start in the year 2000 or something. At least the data is good. And then that's 2005. Let's see how. But the good news is that that's when Google started. So my suggestion is to use this Wilshire large cap and read that in. So I hope that let's get to the very, very final point. The final point here is that when we go to I called it Google Read. Now I'm going to call this Google Read Stocks from Google and Fred. Okay, that's Federal Reserve economic data. I know that now. Okay, and now we're not quite where we were. I agree, but we're getting there. And the good news is by doing this again, I think the spreadsheet techniques and the statistical analysis that's kind of better than what I had done in the original sheet anyway. Hopefully finance.yahoo will come back and we'll be able to use them again. We'll see what happens. All right, so that's getting the stock price indices, and we're kind of getting there now.